Well, hello and welcome to the Hammond Iles Wealth Advisors Financial Power Hour. Today, we'd like to welcome you, and we'll be talking about navigating 2024, investing with confidence in uncertain times. And many times in years, there are opportunities to choose a word for the year. And when it comes to finances, the economy, and the financial markets, I would say the word for the year is uncertainty. There are a number of things that we'll talk about today that lead into that uncertainty. And we want to talk about how do you stay committed to investing through these uncertain times. Now, just a few disclosures in that Hammond Iles Wealth Advisors does not provide any tax or legal advice. So make sure that you consult your professional team member for your particular situation. Also, we're going to talk about the Standard & Poor 500 Index in today's presentation. The Standard & Poor 500 Index is made up of the 500 largest stocks traded in the United States. And it is an index, and it is not able to be invested in directly. You certainly can invest in investments that follow the index, but the index itself is unmanaged and is not available for direct investment. And so as we go through, as I mentioned, your questions are always welcome, and be happy to answer those towards the end or as it's appropriate throughout the presentation. You can ask those questions by typing those into the chat, which you'll find the chat button at the bottom of your screen. So today's agenda, what we're going to talk a little bit about today is how did stocks perform in 2023? What drove the market performance in 2023, much to a lot of people's incorrect expectations? Where are we now, to take a look at where we're at, and then taking a look forward as to what do we see in the forward for 2024, and then how can we invest for the coming year with that uncertainty in mind. So let's talk a little bit about how stocks performed in 2023. Well, the year ended with the Standard & Poor 500 Index ending at 4,769. And you'll see here from some of the major investment banks on Wall Street that nobody got it right, or even close to being right. The group average of predictions for the S&P 500 Index for 2023 was around 3,800. Many investment firms felt that there was going to be a recession in 2023, but it never materialized. And just the opposite happened, that we saw a run-up in the market, especially in the fourth quarter, to end the year substantially higher. The S&P 500 Index ended the calendar year 2023 up 24%, although I believe that number is skewed based on just some components of the S&P 500 Index. And I'll talk a little bit about the Magnificent Seven, which in my opinion aren't so magnificent if you want to invest for the long term. So let's talk a little bit about market performance in 2023. What we saw, some of the highlights for the year, is that the Federal Reserve on February 1st raised interest rates 1/4 point, and that was the last interest rate hike that they have made. So now the target rate for the Federal Reserve is between 5.25% and 5.5%, and it's remained at that level since February 1st. And what we saw immediately after that, and what led to kind of the downturn here, is that we had several banks that went under in March of 2023, and that certainly weighed on the financial markets. And I know that, Laura, you've asked the question on, have I heard of any significant banks for sale right now? And do I have any idea if this is true, or if so, why is this happening? I don't believe that the number of banks for sale right now is any higher than it would normally be. Certainly, there are always outliers in any industry, and the banking industry is certainly one of those, depending on the focus of the banks. And last March, the banks that went under focused on primarily technology companies. And as a result of that, when those technologies were burning through their cash, they needed to withdraw funds dramatically, which caused kind of a run on the banks in that sector. But the banking industry as a whole is sound. And that's one of the reasons why we saw the markets after March turn around and pick up as the FDIC, the Federal Deposit Insurance Corporation, step in to support those banks through transitions. Some of them were sold and acquired, and how the banking industry led out of that. Then in the summer, we started to see that inflation started to peak and started to trail off. So in June, inflation hit its 2-year low, and that continues to gradually move downward since then. In October, the 10-year Treasury note hit just under 5%. We saw a spike in interest rates at the 10-year rate. Leading up to that point, we had what was called an inverted yield curve, where short-term interest rates were higher than long-term interest rates. And we started to see in October some concerns about the economy and what was going on in the world, and longer-term interest rates started to increase. And then, of course, in October also was the breakout of the conflict in Gaza after the attack in Israel. So that also has weighed and continued that downward trend in October. Starting in November, then, is when we saw the inflation numbers come back in, continuing to be lower. And so then the expectation was that the Federal Reserve had reached the peak of its interest rate hikes and would start to look at lowering interest rates. And the Federal Reserve, in its December meeting, actually mentioned that they see rate cuts coming in 2024. Now, the most recent Federal Reserve meeting, they held interest rates steady and are still in a wait-and-see game. And I'll talk a little bit about that when we look at some of the economic indicators. Now, also looking back in 2023, looking at quarterly earnings, one of the expectations that would lead to a recession, as you see here, is that the change in quarterly earnings from a year early, quarter by quarter, for the S&P 500 index, again, those 500 largest, saw earnings decrease. You see the gray bars actually go negative for 3 quarters towards the end of 2022 and into the first 2 quarters of 2023. However, that started to turn around in the third quarter of 2023 with earnings starting to increase. So if we're looking over all 4 quarters for the calendar year 2023, here is kind of an overview or a 30,000-foot view looking at the economy as a whole. Many economists predicted that we would have a recession. Technically, to enter a recession, the gross domestic product, or the growth of the economy, would need to dip negative 2 quarters in a row. And actually, we saw the economy speed up in the third quarter. It's one of the reasons why the markets started to take off at the end of the year. But you'll see that we came nowhere close to having a gross domestic product at even or any close to negative. And one of the contributing factors of that is we still have a very strong unemployment, I should say, an employment market. The unemployment rate is very low, over a 50-year low. We've remained under 4% unemployment for the entire year of 2023. And inflation, as you see, started out the year at 5%, which was lower than the peak of the 8% that we saw in 2022. But it has gradually diminished. But one of the things I do want to point out about inflation is that it's still above the 2% target rate for the Federal Reserve. And that's one of the reasons why they're continuing to hold interest rates where they are, because the economy with inflation is still showing a little bit of more inflation than they would like to see in the economy. Consumer sentiment, interesting enough, despite corporate earnings and things improving, having a very low unemployment rate, the consumer sentiment has been still relatively low, not very strong. And one of the reasons for that, or at least what many economists or analysts are saying about that, is that we saw a rapid rise of prices in 2022, and that's when we saw interest rates go up as well. And even though inflation has started to come down, we have not seen deflation, meaning that the prices have not come down in many areas. Although we've seen some areas of food, for example, where pricing has come back down a little bit, many prices have gone up with the pandemic and then the inflation following the pandemic, but those prices have stayed. So inflation has slowed in that the prices haven't gone up more, but we haven't seen those prices come down significantly. And so as a consumer, we are expecting prices to go back to the way that they were pre-pandemic, but that hasn't happened and most likely will not happen. And that's why consumer sentiment is a little bit lower. Now, along with inflation in 2022, we saw those rapid increases in interest rates, and that certainly really impacts the housing market, not only for those that are looking to buy a house, but it also impacts the home builders. And that's why their sentiment index has gone down, and that they are feeling squeezed, and that we've seen the price of housing going up, as well as interest rates, which is causing fewer buyers to come into the market. We have seen interest rates on mortgages come down a little bit so far this year, but it's still at a level that's keeping some first-time home buyers out of the market. So where are we now? We've taken a look at where we were in 2023 and what we've experienced over this last year. So where are we now as we take a look? And to add some perspective to where we are now, I want to take a flashback to November of 2020, which was a time frame when we were just coming out of the pandemic, when it started to feel like we were somewhat back to normal. And so when we look at a lot of the gauges that we have here on different areas of the market, you'll see that there are many areas that are in green that are very positive, as opposed to red being negative. And I'd like to point out a couple of things. One is that the monetary policy at that point was still very loose, in that interest rates were at historical lows. So that was providing an opportunity for many businesses to access loans at very low interest rates, as well as for all of us right below that, looking at housing and mortgages. Many people locked in very low interest rates. And at the bottom of that first column, you'll see inflation. Inflation was very, very low, and it was actually under the 2% threshold for the Federal Reserve. So in November of 2020, we were looking good. Everything was looking very positive, and that was kind of reflected in a very positive year in the stock market in 2021. But then in 2022, we saw inflation start to poke its head up dramatically as spending picked up. And as a result of that, a lot of these dials shifted to red. or into the yellow, into neutral. We saw inflation pick up, and because of that, monetary policy tightened. We saw interest rates go up dramatically from basically 0 to over 5% in 1 year. And so that created a lot of headwind for the US economy. And that's one of the reasons why many economists expected that going into 2023, we would have a recession. Now, if we fast forward to just this year, taking a look at where we are now, as of the end of January, what we'll find is that inflation has eased. A lot of those red dials have eased back to neutral. We don't see a lot of green, or actually any green on this screen at this point. There are still certainly a couple of things that are in the red that I would highlight that I have some concerns about right now. Certainly there is geopolitical risk if we look in the bottom right-hand corner, certainly with the conflict in Europe as well as in the Middle East, as well as continued tensions with China, with Taiwan. Those are still in kind of the negative impact warning level. Also, you'll see to its left the equity market valuation, and I'll talk a little bit about this in a few slides, but the market in some areas are looking very overvalued, and that causes some concern for me in certain areas. And because of some of the conflicts and things going around, the international economic outlook is also still looking as kind of a negative warning sign as that conflict in Europe continues to drag on. So just looking at underneath some of those dials, the U.S. leading indicator, I'm sorry, let me say that again. The U.S. leading economic indicators index, the LEI, it is made up of 10 different factors that goes into kind of trying to prognosticate or estimate where the market is heading. And you'll see that the 0 is kind of the middle ground where things are just normal, but nothing stays normal for very long. So we're typically either above that line or below that line. So if we're above the line, leading economic indicators are pointing that the economy is expanding, that it's growing. And if it's below the line, it means that the economy is slowing down or pulling back. And what you'll see here is each time that that leading economic indicator number has dipped, that it typically has been a prediction of a recession, both in 2001, 2007 to 2009, and in 2020 with that sharp pullback with the pandemic. However, nothing is 100%. And what we have seen is that the pullback of the leading economic indicators has not led to a recession. At this point, it's starting to show that we may be at a bottom of the leading economic indicators. It's been kind of flat, and the question is will it resume its upward trend, or will it dip lower as it did back in 2001? You can see it kind of plateaued and went down a little lower before it went back up. But we have not experienced a recession as the leading indicators have slowed down. The economy itself has been very resilient despite a lot of these headwinds and challenges. And while we're talking about headwinds, so what are we facing as headwinds here going into 2024? As I mentioned, inflation continues to be a concern, that it is higher than the 2% target rate for the Federal Reserve. So the Fed policy of keeping rates higher longer can also be a headwind, even though it's estimated that rates will go down this year. The longer that they keep them up, that will continue to be a headwind for the economy as well as corporate earnings. I think also corporate earnings is listed here because of the fact of that valuation. And I'll go into that in another slide, but that valuation level is a concern for me and many analysts. Also, there is the talk about that R word, the recession, and we continue to have those geopolitical tensions. Now, on the flip side, the potential tailwinds, or what we have potentially that could sustain the economy and cause the markets to increase, are that we do see moderating inflation. Even though it is higher than the federal target, it is coming down, so it is moderating. We are starting to see the impact of artificial intelligence, or AI, in that it's becoming a tool that's more widely used in different aspects of our lives, and most likely we'll continue to see that happen. It kind of came on the scene in 2023, and I think really will spur things higher going into 2024. Higher profits, as we mentioned on that bar chart, looking at corporate profits, profits of corporations are improving. And although Fed policy has been a headwind, a more dovish Fed with the possibility of rate cuts in the future is a tailwind if we do start to see that. Hopefully also we're starting to see some stabilization in the China economy, although that is being questioned at this point on whether they have really hit the bottom with their economy. We'll start to see their economy stabilize and improve in 2024. So going back to that valuation metric, I want to touch on a few things about the S&P 500 index and the valuation in general. So this chart shows that if we look at the Standard & Poor's 500 index going back to the late 90s, that the 25-year average has been just under 17 times, meaning that the price of a stock has been equal to 17 times the earnings. So when we see prices get higher, and especially above the one standard deviation, which is about 20 times earnings, there is going to be some pressure on the markets, because one of two things needs to happen at that point. Either earnings has to go up so that this ratio of price to earnings comes back down, or the price has to come down to bring this ratio back in line. And so where we find ourselves as of September 30th of 2023 is that the S&P 500 PE ratio was showing at just under 18, so a little bit above the historical norm. However, if we take a look at where that valuation is as of this week, from the Wall Street Journal as of February 2nd of 2024, the current ratio for the S&P 500 index is now at 22. So it's slightly above that. And when we look at some other indices, like the NASDAQ, which is very heavy in technology, is now at a valuation close to 31 times earnings. So it is a very high ratio. But one of the things that I wanted to point out to you, especially about the Standard & Poor's 500 index and where we find the markets right now, is that it's a tale of two stories. Over the last year, we have seen a dramatic increase in the price of what is called the Magnificent Seven. That's 7 companies that are Apple, Alphabet, Amazon, Meta platforms, which used to be Facebook, Microsoft, Tesla, and NVIDIA. Those 7 companies, which now make up over $12 trillion in market value, make up 30% of the S&P 500 index. So as those 7 companies accelerate, as people pile into those stocks, it's pushing the S&P 500 index up. And distorting kind of really how the overall market is doing. So if we take a deeper dive into that 22 times earnings now, really what we see is that if you stripped out the 7 magnificent stocks, the S&P valuation would only be at 15.5 right now. So that means that it's actually undervalued. So if the other 493 stocks in the S&P 500 index are actually undervalued compared to the historical average, whereas those magnificent 7 are currently at a PE ratio of 35 or higher, depending on the day that you're looking at. So they are off the top of this chart. So again, the question becomes is when those ratios get that high, one of two things needs to happen to bring the market back into balance. Either earnings of those companies has to accelerate to meet the pricing that's already been priced into the market, or those prices have to come down. And so I have a lot of concern about the S&P 500 index and large company stocks in general, especially technology companies, because at this point they look very overvalued. And other parts of the market, like small size companies and even the smaller companies in the S&P 500 index, look a little bit undervalued. So what are the forecasts, or where do we go from now with that information? Well, if we take a look at quarterly earnings, it's projected again that it's going to be a headwind. I'm sorry, not a headwind, a tailwind for us for 2024, and that the earnings for the S&P 500 index companies are projected to increase. That we may see a little bit of a dip here as coming out of the fourth quarter of 2023, but that the earnings will increase back up through 2024, with it kind of flattening out a little bit towards the end of the year. Interest rates and inflation, again, the odds are that we'll see interest rate cuts. Right now, it's about a 50-50% chance that we'll see rate cuts before the June meeting, and that it will bring the rates down to about 4.75% to 5%, or what the odds are showing us. Also, if we're looking at the market through the eyes of the gross domestic product or the growth of the economy, again, the projections now are showing that it will slow down a little bit in this first quarter, but it is not going to turn negative. So it most likely will avoid a recession this year. And although unemployment will continue to increase in the unemployment rate, it's still a very strong employment market, with being down in the 4% range, which by historical norms is very low. So one of the other things in taking a look at the pulse of the jobs market is just taking a look at consumer spending. When we look at the U.S. economy, the U.S. consumer makes up about 3/4 of the gross domestic product, or the activity in our economy. So how the consumer goes, our economy goes. And the chart on the left here, if we're looking at the aggregate excess savings, what we have seen over the last few years is that during the pandemic, when we weren't going out, when we were staying in, we weren't traveling, many individuals were increasing their savings. And at August of 2021, we actually hit a peak where they calculated that the aggregate excess savings that people had was around $2 trillion. Now, what we've seen since then, and one of the contributors to inflation since then, has been people have been spending that money. We've been able to travel more, being able to get out of the house and are shopping more. And so that has kind of drawn down those excess savings and drawn it down. And also on the flip side of that, what we have seen is that changes in household debt has started to increase. So people are beyond spending what they had in their savings. People are adding back to balances on their credit cards, as well as other forms of loans. So although the forecasters at all the investment firms were completely off base by more than 20% for 2023, it doesn't stop them from trying to make forecasts for the future. So for 2024, here's their best guess, taking a shot in the dark at the dartboard here. Their average is at 4,817. And keep in mind that we started the year at 4,770. So they're looking at basically a flat year, slightly to the positive. Some of the investment firms are a little bit more optimistic, but nothing dramatic, just a couple hundred points. They're looking at 5,000 as the target, which is very interesting since right now the S&P 500 index is currently flirting with that 5,000 point range and may cross over it for the first time here in the near future. So I don't want to spend a lot of time on forecasts because, as I've shown early on, they're not accurate. They're not dependable. So if they're not dependable and we have those headwinds such as geopolitical risks, we now are also in an election year, which has its own twists and turns this year. What are we going to do to invest with more confidence? And so I want to highlight a few things to make sure to give you the confidence that it's not a matter of being in or out of the market at the right time. It's how long you stay committed to the market. I think this chart does a great job at showing the value of discipline, staying invested for the long term. Because when we look at the performance of the S&P 500 index over a one-year time frame, 73% of the time, it's positive. Roughly a quarter or 27%. So 1 out of 4 years, it'll be negative. But those are pretty darn good odds that we'll have 3 out of 4 years of positive and 1 negative. And then historically, when you extend that out, if we go to 3-year time frame, you're now up to 84% positive. If we extend that out 5 years, you're now at 88% positive. And if you go out 10 years, you're at 94% likelihood that the market will be positive based on historical returns. And as always, historical returns are never a guide for future performance, but certainly give us an opportunity to evaluate kind of how the markets work and how they've performed in the past. One other aspect that I want to focus on about staying invested is that just missing a few of the best days in the market can have a dramatic impact in your financial well-being. So this study by BlackRock took a look at the performance of the S&P 500 index for the last 20 years, between 2003 and 2023. And if you invested $100,000 in 2003 and just let it run for the next 20 years, that $100,000 would have grown to just under $648,000, a dramatic increase in value. Now, if you timed things and tried to get in and out of the market and you missed just the 5 best days in the stock market, so that's 5 out of 5,000, you would have seen a decrease in your return by 37%. Your 100,000 would have only grown to around $409,000. And it's amazing to look at the detrimental impact of missing some of the best days in the stock market. If you go all the way to the right and look at missing less than a month, the best 25 days out of 5,000 days, you would have ended 20 years with just a slight return on your money and actually probably would lose value compared to inflation. So it's important to stay invested and to be investing at a level of risk that you're comfortable that allows you to stay investing. So what are the kind of the three basic investment rules to being invested in the markets? And what we guide our investments around are these three rules. The first is that we should all own equities or stocks. It doesn't mean that you should be 100% in the stock market, but there should be a portion of your portfolio that's invested in the stock market, because what we see over time is that there is no better way to invest to outpace inflation than to invest long-term in the financial markets. The second is to diversify globally. And I know that certainly here in the US, we've had a few years where that S&P 500 index has done extremely well. You may have said when I told you that on a calendar year basis, it was up 24% last year. You said, hey, well, that's amazing. But however, if we take a look around the world, the US makes up only 52% of all publicly traded stocks. And if we take a look back at 2023, what if I told you that if you invested in Argentina, your investment would have been up 53% last year? If you invested in Poland, your investment would have been up 50% last year. And in Greece, you would have been just shy of 43%. The US was number 11 on the list of countries around the world if we're looking at performance. And so if you're only invested in the US, you're missing out on that growth around the world. So it's important to be diversified because we can't predict what countries will be the next ones that will be the best performers for 2024. And so it's important to maintain a globally diversified portfolio. Now, once you create a portfolio that is diversified globally, has the amount allocated to stock that you're comfortable with so that you have a level of risk, the third rule is then to make sure that you rebalance. Many people, when they see an investment growing or a portfolio growing, they just want to let the winners run. And the problem, as I mentioned with valuations, is that one of two things has to happen. And one of those is that the prices can come down. So it's important that we rebalance portfolios on a systematic basis to maintain the level of risk that you feel comfortable with in your portfolio. So if that allocation is 50% stock and 50% bonds, and we have a great year in the stock market and that 50% grows to 60%, you should trim back that part of the portfolio, buy more bonds while the market is high, and bring it back to that target allocation. And the reverse is same as well, but it's very difficult to do. When the markets pulled back in March of 2020 and dropped 30% in a matter of 3 weeks, the market is down, and at that point, it would make sense to sell some bonds and buy more stock while the market's down. But when the world is in chaos and we're not certain what the future holds for us, that can be an emotional decision and very difficult to make. And that's why it's important to either take a non-emotional path in managing a portfolio or engage an investment firm like Hammond Iles Wealth Advisors to manage your portfolio for you, that we have a systematic process in place to maintain the diversification in that portfolio. So what are some steps for you this year? So I hope that in taking away from this presentation that you'll realize that our ongoing education is in an effort to keep you informed. But it's also important for you to keep us informed about changes in your life, whether that is a change in your work status or in your relationships. It's important for us to understand that, because that may need us to look at your investments and make some adjustments. Also, it's important to tell us about your investment concerns. It's one of the reasons why we refer to ourselves as financial coaches, is because we are not just an advisor. We're not here to just give you advice and send you on your way. We are here to be a partner with you through your life. And part of that role is coaching you through the difficult times when it is uncertain where the future holds. And then as a reminder, we want to make sure that all of your essential documents are up to date. So make sure that you have your will, power of attorney, your living will, your healthcare proxy, and if you have a trust, your trust documents, that they're all up to date. And I would also mention, in addition to those legal documents, it's also a great time to take a look at your beneficiaries. Make sure that your beneficiaries on any retirement accounts, as well as any annuities or life insurance, are up to date in the way that you want to have them. If you need any assistance in reviewing those or would like some guidance, please don't hesitate to reach out to our office, which you can call our office or contact us online at hiwealth.com. Now, some action steps for us. We are always continuing to work on keeping you informed. We will have these educational workshops on a consistent basis, and the recordings will be available to you on our YouTube channel at any time. I know one of the things that I didn't touch a whole lot on in this presentation is the upcoming election. We will have a special session focused solely on that. But if you're concerned about that, I encourage you to go to our YouTube channel and watch the presentation titled Politics and Portfolios, where we talk about the historical impact of who's in the White House, who's in Congress, and who controls Washington. What you'll find is that it really doesn't matter. If you look over any 4 or 8 year time frame, despite who's in the White House, whether you love them or hate them, the markets have been higher in all but 3 presidents. So then we want to also manage your investments according to your personalized investment strategy. And that's where we systematically rebalance and review your portfolio each quarter to make sure that we're following your personalized strategy. And that's why it's also important that you inform us if there's any changes in your life that may impact your personal investment strategy. And we'll continue to remain abreast of all economic factors, and we'll share that information with you on an ongoing basis through our emails and our education. So beyond that, how can Hammond Iles Wealth Advisors help? Well, if you are not currently a client of Hammond Iles Wealth Advisors and you would like a free conversation, if you go to our website, which is hiwealth.com, there's a button in the upper right-hand corner for a free conversation. Just click on that and you can schedule it at your convenience to talk about. One of the things also that I want to highlight, whether you're an existing client or not a client, is that Hammond Iles Wealth Advisors believes that we all start from zero. We all start from somewhere, and that's why in working with families across multiple generations, we have no minimum investment amount. So whether it's your child or grandchild that you're trying to encourage them to start paying attention to their finances, or the other way around, if you want to encourage your parents or grandparents to focus on their investing, we have no minimum investment amount. Continue to monitor our website and look at our emails for our ongoing financial power hours. And as I mentioned earlier, all of our recordings are on our YouTube channel, which also includes our Financial Friday videos, which are just a 60-second video or less on a topic every week. And those get put out on our YouTube channel, as well as through our social media. So I encourage you to follow, connect, or like us on Facebook, Instagram, or LinkedIn so that you can get all those videos as well as stay connected with our other information. There are also a whole host of resources on the Hammond Iles website. One that I think is our most popular and I would recommend is our family inventory workbook. Many times when someone passes away, the information is scattered in multiple places. This workbook, whether you fill it out digitally or print it out and have a hard copy, allows you to consolidate all of your financial information in one central place for anyone that may need to pick up when you're no longer around to do that. So I'd like to just wrap up by thanking you for joining us today. Again, if you have any questions that we don't answer today, please email them to us at hello@hiwealth.com.